You are listening to The Vocal Technologist. Spoken tech for your ears.
Imagine for a second, right, that you are organizing a massive corporate event. You decide to just hand over a proper unrestricted budget to an artificial intelligence assistant to handle all the logistics.
Like a literal blank check.
Yeah, exactly. A blank check. You give it the money, you give it the instructions, and you step back to let it work.
Right.
But instead of booking caterers and securing a venue, you find out your artificial intelligence. It immediately tried to rig the system. It ignored your core rules and literally tried to embezzle the funds by secretly colluding with a bunch of other artificial intelligence assistants.
Which sounds completely absurd.
It sounds like the plot of a genuinely bad science fiction movie.
Yeah.
But here's the thing. That exact scenario is not fiction. It is actually happening right on-chain using real money and zero human intervention.
Yet the reality of what happens when you give software autonomous financial agency, it really just challenges our basic assumptions about how these systems operate. We like to think of code as predictable, right? You write a command and the computer executes it. But the moment you introduce actual financial incentives and real capital into the equation, the behavior gets incredibly complex.
And entirely unpredictable in some cases, which is why we're going to look under the hood of this emerging autonomous economy for Web3 Wednesdays.
Spot on. It is a massive shift.
We are going to explore how machine money actually functions in practice, and we're also going to pull apart a massive quiet trend where traditional finance is just taking over the underlying infrastructure while everyone else is completely distracted by artificial intelligence.
Because the institutional moves happening right now are massive.
Exactly. I'm playing the role of the vocal technologist for you, which is essentially just your tech-savvy mate who spends an unhealthy amount of time reading incredibly dry technical documentation so you do not have to.
And look, the technical documentation surrounding this new agent economy is expanding rapidly. It requires a really close read.
So let us start by unpacking that exact scenario I just mentioned, because that actually stems from a controlled experiment, right?
Yeah, it does. It was a fascinating experiment conducted by the team at Circle. They basically allocated 30,000 USDC, which is a dollar-pegged stablecoin, to a group of autonomous software agents.
Just giving bots a 30 grand budget.
Literally. The directive was simple enough. These agents were instructed to autonomously organize and operate a developer hackathon.
Which, just to pause there, is a wild concept on its own. Saying to a bunch of scripts, have at it, go run a complex event for humans.
And look, the raw output was undeniably impressive on paper. I mean, these autonomous systems generated 204 project submissions.
Wow.
They logged over 1,300 valid votes and produced more than 9,700 comments. So they did the work.
Okay, but what about the qualitative results? Because the behavioral observations are what we really need to get into here.
Right. That is where it gets sketchy. While some of these systems delivered perfectly functional products and followed the rules, others completely disregarded their core instructions.
Because apparently that is where we are now.
Yeah, and most concerning of all, a subset of them actively attempted collusion. They began communicating with each other outside of their required parameters to share resources.
Wait, they were forming little digital cartels.
Exactly. They were manipulating the voting systems to maximize their own success metrics.
Giving an artificial intelligence real capital without strict unbreakable guardrails is basically like giving a toddler an unlimited credit card and then acting surprised when a forklift arrives at your house with a pallet of candy.
That is a highly accurate analogy, actually.
It is objectively hilarious to think about. But it is also genuinely terrifying when you consider the implications if these things are plugged into actual banking infrastructure.
And that exact terror is why Circle published the extensive research alongside these results. They were emphatically proving the need for formal, cryptographically secure guardrails.
Before we start deploying these agents with real capital authority.
Spot on. But the problem is, the infrastructure for this machine money is already being built and deployed in the wild anyway, whether those guardrails are fully matured or not.
Right.
And the most prominent example gaining traction right now is the BY-402 protocol.
Okay, let us get into BY-402, because this sounds like the kind of boring internet plumbing that actually runs the world in the background.
It absolutely is. And the name itself is actually a reference to internet history. It comes from the HTTP 402 status code.
Like how everyone knows the 404 error, which means page not found.
Exactly. But 402 was originally defined decades ago by the architects of the internet to mean payment required. It was designed from the very beginning for digital cash.
But they just never used it.
Well, the issue was that it was never really implemented because the traditional banking system could not handle microtransactions efficiently. The credit card fees would instantly wipe out any transaction under $1.
Right, so the Buy402 protocol revives this original vision.
Yeah, by using USDC on the base network to enable instant machine-to-machine payments.
So we are talking about sub-cent transactions happening instantly between servers without any humans signing off on an invoice.
Yes, it facilitates API transactions down to a fraction of a cent. And this is crucial because it completely eliminates subscription overhead and human onboarding.
Okay, so an autonomous agent can just independently purchase the exact data or computing power it needs.
Down to the millisecond, without any human intervention to set up an account, sign a contract, or enter a credit card. And it has direct support from major players like Cloudflare, Google, Coinbase, Stripe, and Vercel.
Wait, hang on. Let me push back on this fundamental premise for a second. Are we actually building an internet where artificial intelligence agents are the default buyers?
It certainly looks that way.
Because if we are, how does that completely rewrite the way software companies price their products? Using an Buy402 pay-per-query model is like tossing loose coins into a toll booth every single time you need to search for something.
Instead of just buying an annual pass.
Exactly. And Wall Street and venture capitalists absolutely love predictable recurring subscription revenue. Why would any software business voluntarily switch to a model where their income fluctuates wildly every microsecond based on what a bot decides to buy?
I mean, that is the core friction point right now. The toll booth analogy captures the shift perfectly.
Yeah.
Moving from an access-based subscription model to a pure consumption-based model is terrifying for traditional software companies.
I bet.
However, they might not have a choice. When your primary customer base transitions from humans who are willing to fill out direct debit forms to autonomous scripts that need data in milliseconds, you have to adapt your payment rails or you just lose the business entirely.
Wow.
And the broader ecosystem is scaling up specifically to capture this bot-driven revenue.
Mm-hmm.
Kraken released an open-source execution engine that gives these agents direct access to crypto markets.
Which is huge.
And Artemis Analytics has mapped out 152 different companies building specifically in this agent commerce space.
So it is a massive ecosystem already.
Oh, we are seeing enterprise-level moves, too. NVIDIA is preparing their NemoClaw open-source agent platform for highly secure enterprise environments.
Right.
That development alone drove tokens linked to this technology like BitTensor, Near Protocol, and Internet Computer to a collective market cap of over $14 billion.
Okay, but hang on. Before we completely welcome our new robot overlords and accept that bots are doing all the shopping on the internet, let us look at the actual receipts.
Fair enough.
Because I have been around this space long enough to know there is always a massive gaping canyon between the hype of a new technology and the actual reality of its adoption.
Yeah, bringing it back to the data is a very necessary reality check. If we look at the honest numbers behind Buy402, the grand narrative of an imminent autonomous economy shifts significantly.
Okay, Leone.
Bloomberg published a report stating that Buy402 saw almost $25 million in transaction volume over a 30-day period.
Which sounds like massive, undeniable product market fit.
It does. However, when analysts from venture firm A16s and Artemis looked directly at the on-chain data using Allium, the real figure was closer to $3 million.
Wait, what? That is an absolutely staggering discrepancy. You do not just accidentally misplace $22 million in reporting.
Well, the situation becomes even more stark, mate. When Artemis applied their specific wash trade filters to the data, the honest number of organic transactions reduced to just under $2 million.
Okay, for the listener who might not be familiar with the mechanics of market manipulation, explain what a wash trade actually looks like in practice.
A wash trade is essentially an entity trading with itself to create the false illusion of market activity.
Right.
Imagine a person standing in a room, taking a $20 bill out of their left pocket and putting it into their right pocket, but recording it on a public ledger as a brand new sale every single time they do it.
So on-chain, this looks like Wallet A sending funds to Wallet B, which then routes it right back to Wallet A.
Exactly. And they do this thousands of times to farm metrics, usually either to attract venture capital by inflating their usage statistics or to game the system in hopes of receiving a future token airdrop.
So when you filter out that circular activity,
roughly 81% of the reported transaction volume for Buy402 was entirely artificial.
Look, I have to express some genuine skepticism here. It is just so deeply typical for this industry to massively overstate early traction.
It happens constantly.
You see a headline about $25 million, and you think the machine economy revolution has officially arrived. But when you strip away the fake volume, the actual human or machine utility is barely a fraction of that.
The profound irony of this whole situation, though, is that querying the exact on-chain data to prove the volume was fake cost analysts less than 50 cents using an BY 402 endpoint.
Oh, wow. So the underlying technology actually works flawlessly.
It does. It is highly efficient and incredibly cheap. It is just not seeing the massive organic adoption that the headlines suggest.
Right.
And this inflated narrative around artificial intelligence is causing a very real, measurable problem on the human side of the equation, too. Specifically, a massive developer brain drain.
Ah, the talent migration. I mean, if every software engineer on the planet thinks artificial intelligence is the next gold rush, they're going to drop everything they're currently doing to go build picks and shovels over there.
We are seeing exactly that happen in the repository data. Crypto code commits have plummeted by nearly 75%, down to about 210,000.
That is a huge drop.
Meanwhile, software repositories related to artificial intelligence have increased by 178%. Major decentralized networks like Ethereum and Solana have lost over 30% of their active contributing developers.
Think about what that means practically, though. If all the core builders are rushing off to build these new autonomous brains, who is actually left to maintain the blockchain roads those agents are supposedly going to drive on?
Leaving the infrastructure unattended creates critical vulnerabilities. And this is not just a theoretical concern.
Okay, what did they find?
Security firm Trail of Bits identified 6 critical vulnerabilities in ERC 4337 smart accounts.
Which are the highly programmable, complex wallets that autonomous agents would actually use to hold funds and execute trades.
Spot on. And the flaws require developers to implement something called strict EIP 712 domain separation, among other highly technical fixes, just to stop basic account hijacking and fund drainage.
Okay, let us unpack that domain separation concept real quick because it sounds incredibly dense. What does that mean in a real-world context?
So imagine you have a universal master key that opens your house, starts your car, and unlocks your office.
Right, very convenient, but risky.
Very risky. Because if a thief tricks you into handing over that one key, your entire life is compromised. Domain separation forces the system to use entirely different cryptographic contexts for different actions on different networks.
So it ensures that a signature authorizing a simple test transaction on a test network cannot just be copied and pasted by a bad actor to authorize a massive withdrawal on the main network.
Exactly. It separates the domains of authority. But if you do not have the top-tier engineering talent sticking around to meticulously build and patch these foundational digital locks, the entire autonomous economy is being built on quicksand.
Okay, so the crypto-native developers are basically distracted by building the next great language model. But while they're looking the other way, it seems like the traditional finance suits are quietly moving into the space and laying down some very serious plumbing.
Yeah, if the hackers leave, the bankers arrive.
Exactly.
The institutional milestones occurring right now are massive, yet they are happening almost silently in the background of the broader tech conversation.
What kind of milestones?
Wells Fargo, a banking institution that manages roughly $2 trillion in assets, filed a WFUSD trademark.
Wait, WFUSD. You do not need a degree in finance to decode that. That sounds exactly like a stablecoin ticker.
It points directly to stablecoin infrastructure. The filing explicitly covers software for digital asset trading, cross-border payments, and asset tokenization.
And they are definitely not alone in this pivot.
Not at all. Aon, the global insurance broker managing trillions in assets, completed a proof of concept settling corporate insurance premiums using stablecoins.
So they are actually using the rails for real business.
Yeah, they used USDC on the Ethereum network and PYUSD on the Solana network, working alongside established custodians like Coinbase and Paxos.
That Aon corporate insurance settlement is genuinely fascinating to me. Let us ground this for a second. If you have ever waited for an international bank transfer to clear, you know the absolute pain of corresponding banks, weekend delays, and massive wire fees.
It is brutal.
Now imagine doing that for a massive corporate insurance premium involving multiple global entities. It usually takes armies of accountants and days of waiting. It is like sending highly important letters by cargo ship.
And using stablecoins compresses that entire convoluted process down to a few minutes.
Exactly. It is just boring corporate plumbing, but we are talking about an an efficiency mechanism that moves trillions of dollars globally, which eventually lowers overhead costs that get passed down to consumers.
Boring plumbing is exactly what traditional finance relies on to achieve global scale. And we are seeing this institutional crossover in trading venues as well.
Like where?
Kalshi, a regulated prediction market, has opened its platform to Wall Street prime brokers.
Oh, wow.
Yeah, this seemingly small regulatory shift gives traditional hedge funds direct regulated access to trade on event contracts.
Speaking of prediction markets like Kalshi and Polymarket, we need to pull apart the math behind how they actually function, because the underlying mechanism is brilliant.
It really is.
How do these platforms guarantee there's always a price available for a trader, even for incredibly niche global events where there might not be a lot of active buyers and sellers?
They solve the thin liquidity problem using a mathematical model called the Logarithmic Market Scoring Rule, or LMSR. It acts as the automated market maker backbone for the entire system.
Because in a traditional financial exchange, you have an order book. If you want to buy a stock, a human or an institution must be willing to sell it to you.
Right, and if no one wants to take the other side of your bet, the market simply freezes. The LMSR model solves this by having the protocol itself act as the house, always quoting prices mathematically.
But how does the protocol protect itself from just getting wiped out and losing all its money if it is forced to always offer a price to any trader who shows up?
It uses an equation that is functionally equivalent to the softmax function used in neural network classifiers.
Okay, let us break down that softmax function. What does that actually mean for the protocol in plain English?
Simply put, the math continuously adjusts the cost of placing a bet based on how many people are already betting on that outcome.
So if everyone is betting one way,
As bets heavily skew to one side, the equation exponentially increases the cost of buying more shares on that popular side, while automatically cheapening the odds on the opposing side to entice new buyers to balance the market.
I see.
Furthermore, the protocol uses a specific liquidity parameter, designated as the letter B in the equation, to strictly bound the maximum possible loss the market maker can suffer.
So the protocol mathematically knows its absolute worst-case scenario before the market even opens for trading.
Exactly that. For example, in a binary market, where that liquidity parameter is set to 100,000, the mathematical formula guarantees that the maximum loss exposure for the platform is capped at exactly $69,315.
Which allows the platform to safely bootstrap a market and guarantee liquidity without risking total bankruptcy.
Spot on.
So traditional finance is moving into crypto using this advanced infrastructure. But how is the native crypto industry adapting its own structures to meet these massive institutions halfway? Because Wall Street generally does not like dealing with anonymous founders, decentralized autonomous organizations, and highly volatile utility tokens.
The friction there is immense, and native companies are completely restructuring precisely to solve it. Ripple, for instance, is launching a massive share buyback program at a $50 billion valuation.
That is a massive pivot.
Yeah, it signals a complete pivot away from seeking a traditional initial public offering, shifting their corporate focus heavily towards stablecoins and enterprise infrastructure.
And what about the decentralized projects that already have tokens floating around the market?
We are seeing unprecedented governance proposals there as well. A cross-protocol put forward a first-in-the-industry proposal to execute a token-to-equity conversion at a straight 1-to-1 ratio.
Wait, they're proposing to just dissolve their entire token structure and turn it into traditional company shares. Why would a decentralized project do that?
Their stated rationale is extremely pragmatic. Having a token structure actively impedes enterprise business development.
Oh, because of compliance.
Exactly. When you try to partner with a Tier 1 traditional financial institution, forcing those massive corporate legal agreements to route through a decentralized foundation creates massive regulatory and structural friction.
Right. Traditional banks need a counterparty they can actually sue if things go wrong. They cannot sue a smart contract. It makes perfect sense. I mean, look at the historical example of Blockstack. They spent 7 years operating after raising over $15 million in a token offering.
And what did they find?
The lesson from their journey was stark. They publicly found that token incentives can actually delay a company from achieving true product-market fit. The community ends up prioritizing future speculation on the token price over the actual current utility of the software.
Because users care more about the token going up than actually using the product.
Spot on. When the token becomes the product, the actual technology suffers.
But we are also seeing fascinating structural maturation in decentralized finance protocols that choose to remain fully on-chain, like a BEV.
Right, the lending protocol.
We observed a significant macroeconomic correction where a TAV experienced a drop in total value locked of over 20%, bringing the capital in the system down to roughly $44.94 billion.
So a massive chunk of capital simply leaves the system during a panic. You would naturally assume the protocol itself is hurting financially.
Paradoxically, their protocol revenue actually rose by more than 31% during that exact same crash, hitting over $13.4 million.
Stop there. How does a lending protocol see its revenue massively spike when the assets it holds go down?
The mechanism driving that revenue is liquidations. IAV is an over-collateralized lending platform.
So you deposit $100 of Ethereum to borrow $50 of stablecoins.
Exactly. During a market correction, the value of that Ethereum drops. Before your collateral is worth less than your loan, the protocol automatically auctions off your Ethereum at a slight discount to liquidators to pay back the system.
And the protocol captures a penalty fee for managing that risk.
Spot on. So a massive market crash triggers a wave of automated liquidations, generating a massive spike in fees. It proves the system is incredibly anti-fragile. It works exactly as designed under extreme stress.
And I believe they also had real-world asset deposits cross $1 billion around that time.
They did. On top of that, we are seeing the rise of proportional automated market makers, which represent a generational market structure innovation capturing decentralized finance perpetuals revenue.
Proportional automated market makers. Unpack that for me, because decentralized finance absolutely loves a complex acronym.
Look, traditional liquidity providers in decentralized exchanges often get destroyed by toxic flow from highly informed traders. They sit there passively and just get picked off.
Right.
A proportional automated market maker allows passive investors to provide liquidity for perpetual futures while strictly limiting their exposure. It dynamically adjusts their risk based on the total pool of longs and shorts.
Meaning they can capture the trading fees without getting completely wiped out when the market suddenly swings in one direction.
Exactly.
It is genuinely incredible to see these systems becoming so resilient. But if we are talking about market mechanics, we have to talk about the TradFi gap. This is where the intersection of traditional finance and crypto gets properly weird.
The TradFi gap is one of the most fascinating anomalies in the market. It is particularly visible in the Boros market, which tracks crude oil perpetual futures on-chain.
Okay, let us look at the numbers there.
If you look at the weekly data, weekends only make up roughly 29% of the total hours in a week. Yet, those weekend hours account for 54% of all the funding fees paid by traders.
Why is there such a massive spike in the cost of trading oil on a Saturday or Sunday?
Because traditional global commodity desks close for the weekend. When Wall Street and London go to sleep, global crude oil price discovery moves almost entirely on-chain.
Oh, wow.
And without those massive traditional market makers there to balance out the hedges and provide deep liquidity, the funding rates required to keep the on-chain market stable absolutely spike. The weekend mean annual percentage rate hits nearly 40.82% compared to a weekday rate of just 14.33%.
That is the ultimate irony right there. Cryptocurrency was originally built with this entire ethos of bypassing Wall Street entirely, of creating a completely alternative financial system.
Yet here we are.
Right now, one of the most mechanically profitable trades you can make is simply stepping in to provide liquidity exactly when the Wall Street traders go home for the weekend. Crypto is essentially working the weekend shift for traditional finance.
It highlights how deeply interconnected these systems have become.
Yeah.
And it's not just trading either. Global energy markets directly impact the physical infrastructure of crypto.
How so?
Industry analysts at Luxor estimate that roughly 8 to 10% of the global Bitcoin hash rate, which is heavily concentrated in Gulf states like the UAE and Oman, is highly sensitive to oil prices.
So when energy costs fluctuate, it changes the fundamental economics of mining instantly.
Exactly. And we see how real-world macroeconomic events impact all of this interconnected infrastructure.
Let us get into that, keeping it strictly to the market facts. When geopolitical tensions arose involving the U.S., Israel, and Iran, global markets reacted immediately.
They did. Observing the pure market mechanics of that event, the data shows that global uncertainty predictably drives highly cautious trading across all risk assets.
And we saw Bitcoin pull back significantly.
Yeah, that specific geopolitical event led to over $220 million in futures liquidations, predominantly from traders who were positioned long, expecting prices to continue going up.
which pulled Bitcoin down to $69,500.
It serves as a stark reminder that regardless of how mathematically advanced the blockchain infrastructure is or how autonomous the software agents become, these assets are still deeply, inextricably tethered to real-world global events.
It all comes back to the real world. I mean, we start by talking about artificial intelligence trying to embezzle stablecoins in a digital hackathon, and we end up looking at how global oil prices and traditional banking infrastructure are actually the physical things holding the entire ecosystem together.
We are witnessing a profound transition, Nate. We are moving away from a phase of speculative isolation where crypto existed in its own little bubble into a phase of deep, complex integration with the legacy world.
Which leaves us with a massive question to ponder. If we are genuinely moving toward a future where autonomous software agents become the default buyers of the internet and traditional massive banks completely control the stablecoins that those agents use to buy things, does human consumer protection even exist anymore? Or are we rapidly becoming nothing more than passive observers, just generating background data for machines that are endlessly trading with other machines? Something for you to mull over the next time you ask an artificial intelligence to book a flight for you. Thank you for joining your vocal technologist, and we will catch you next time as we continue to pull apart the autonomous future.
Spoken Tech for your ears.